Good day, everyone, for watching my channel. I just want to say, if you are a subscriber to this my channel, welcome back. And if you are new to this channel, I just want to say welcome and thank you for watching this video. First of all, I want you to just click on the subscribe button, like this video. If there's any question you have, go to the comment section and ask the question. I'll be very willing to reply. On this channel, let me quick introduction to this my channel is that I teach about personal finance, investing, and also I'm a professional forex trader, a chartered accountant. And if you want to learn how to invest or you want to know how to grow your money, I just want you to subscribe to this my channel and let's get started. In this video we will be looking at how to invest in bond. A lot of people don't know how to invest in bond, so in this video I will be teaching you how to invest in bond. I will make it very easy and I'll try my best to break it down for you. Now let's get started. The course outline for today would be what is a bond, types of bond, other types of bond, advantages and disadvantages of bond, tips for investing in bond, benefits of investing in bond, drawback of investing in bonds, and where you can invest or buy bond. Now, what is a bond? A bond is a loan you give to someone or an entity in exchange for an interest for a particular period of time. This is just like when you lend someone money and the person promise to pay you back your money with an interest on it. Bond is also known as a fixed income instrument. These are used by the government or companies to raise money by borrowing money from an investors. This is an example now. A company need money to invest in its business, but they just don't want to go to the bank because the interest rate in the bank is just too high, and they don't want to also sell their shares to investor. They don't want any other person to own part of their company. They don't want to sell their shares, but they also need money. The easiest way they can do it is by issuing a bond whereby people like you and I will lend this company money, and in return they will pay us interest for a particular period of time. Same thing with the government. When they need money, they also issue a bond to the public and you lend them the money, and in return they also pay you back your money, that is, which is your principal, and with an interest, with an fixed with a particular interest. So it is also known as a fixed income instrument because when you lend a company or an entity your money to invest, there's a particular period of time they will be paying you your interest. It could be 5% of what you lend them monthly, it could be 10%, 50%, and yes, and so on. Bonds are typically issued to raise funds for specific projects. That is when the company issue out bond, they just want to, they need money to invest in their business, to grow their business, or the government issue out bond, to fix road, to build, or to just help its budget, or to when they need funding, they issue out bond. In return, the bond issuer promises to pay back the investment with interest over a certain period of time. This is when the bond issuer, the person that issued the bond, will pay you back your investment, the amount you lend the person. They decide to pay you back with an interest for a particular period of time. It's usually, most of the time, it is 91 days, 120 days, it could be yearly, it could be 60 days. So it depends, it just depends. Some is even monthly, some are monthly. I've seen monthly, some every 3 months, 9 months, or yearly every 12 months. So it depends on the person and the agree how you agree, the person decide. So it depends. Types of bonds. Bonds come in variety of form. each with its own set of benefits and drawback. Now, there are three types of bond. There are a lot of bond though. There are just three types of bond that are commonly known, that are very very common. Number one is the corporate bonds. This is an entity. Corporate, it could be an entity, individual, like a company. Now, this is a debt instrument issued by a company to raise capital for initiative like expansion, research and development. This is where a company issue out bond to raise money in order to expand their business, to grow their business, to develop their business for research and development or any other things. Companies issued bond rather than seek bank loans for debt financing in many cases because bond markets offer more favourable terms and lower interest rates. This is exactly what I've just explained. Companies like issuing out bonds. They just don't want to go to the bank. For an example, here in Nigeria, interest rates do fluctuate. It could be 20%, it could be 25%. Just imagine going to go and loan money from the bank and you have to pay back in 25%. Man, it's just too high. So instead they will issue out bond whereby they will not pay the investor, the person that lend them the money, probably 10 or 12%. Which one? This is exactly why they issue out bond. This is why bond is one of the best way for company to raise money to finance their business operation. One of the downside, I think is a downside to it, is that interest you earn from corporate bond is taxable. The interest you earn from corporate bonds are taxable. You have to pay tax on it. Corporate bonds usually offer higher yields than government or municipal bond. That is one of the best thing about corporate bonds, is that their interest rate is more higher than the government's own, because government tend to pay probably 7%, 8, is not that much, while corporate bond is about 12, 15%. So that is why I prefer corporate bonds. The company that issued them are more likely to default than government entities. That is exactly one of the downside about this, is that not all companies do. If the interest rate is just too high, man, I think you should watch out, because companies are very much likely to default. I mean, for an example, if the company goes bankrupt, man, there's you might not even get your money, because a lot they will have to pay their borrowers, their creditors and everything. So there's every possibility of you not getting back your money. That is exactly one of the downside of it. Another one of bonds are municipal bonds. Municipal bonds are issued by a city, town or state to raise money for public projects such as schools, road or hospitals. This is exactly when the state government issue out bond in order to raise money to finance their to finance their projects like building of road, hospital, school. For an example, city might issue municipal bond to build a new bridge or redo a neighborhood park. Unlike corporate bonds, interest you earn from municipal bill are tax free. That is exactly one of the best side, is that the interest you earn from municipal bond are tax free. You don't have to pay tax because it is being issued by by the state government, or by the government, so it is tax free. There are two types of municipal bonds. We have the general obligation and revenue. This, I don't think this one is really important. If you want to know more, then you can search more on it. But this one is not really important. It's the way they use the money to finance their project, which is the general obligation and the revenue. Now, the third one we have is the treasury bonds. The treasury bonds is also known as T bonds. They are issued by the US government. And one of the best side is that they are backed by the full faith and credit of the US government. Treasury bond are considered risk free. That is one of the best thing, is that it is the federal government that issue out this bond, and they are risk free. I mean, when they lend money from the public to finance their project, they tend to pay it back, which like there's no really much risk. And if probably there's no money to pay back, they just order their central bank to print more money, and they'll issue out. So I mean, it is free. But the downside is that these treasury bonds don't yield interest rates as high as corporate bond. That is exactly what I just said before. Treasury bond, they don't tend to pay high. Some they can even pay like 2%, 3%, I mean, which is very very low. But one of the best side is that they are risk free. You tend to get your money, you will get your money back with your interest, which is it is backed by the full faith of the government. So now, other types of bond, we have bond fund. Bond funds are like mutual funds. They that typically invest in a variety of bonds, such as corporate, municipal, treasury, or junk bonds. This bond fund is just like it's just like where the multiple bonds are being invested, whether they buy both the municipal bond, corporate bond, treasury bond, or junk bond. If they are into one basket, they are just into one basket, whereby when you buy one bond fund, it means you are buying into corporate bond, it means you are buying into municipal, junk, or treasury bond. That is whereby instead of you to buy a single bond which might cost $1,000, you can decide to buy bond fund of $1,000, but that $1,000 is spread into, so part of it is invested in corporate bond, maybe like 10% in, or 30% or 40% in corporate bond, or 20% in municipal or treasury or junk bond. And one of the best thing I like about this thing is diversification. I mean, if a corporate bond decide to default or go bankrupt, you won't lose all your money. You won't lose all your money, because municipal bond tends to pay you your treasury bill, and your job you still have some money, you won't lose it all. Bond funds usually pay higher interest rates than bank accounts, money market, or certificates of deposit. That is one of the best side of this bond fund, is that they pay higher percent than bank accounts. I mean, if you have a particular amount of money and you put it in the bank won't even pay you, though they don't even pay you much. And if they want to pay you, I mean, just 0.25% or even 1%, which is very very low. But when you have bond fund, that's when it is diversified. You will be able to invest, you'll be able to get your money, 10%, 50%. That is one of the best thing about bond fund. For a low investment minimum ranging from a few hundred to a thousand few dollars, bond fund allow you to invest in a whole range of bond managed by professional money manager. I've just said it before, with just as little as $100 to $1,000, you can invest in multiple bond. And one of the best thing is that this this bond is being managed by professional money manager. That is exactly, if you buy a single bond fund, you are buying into different entities, into different types of bond, and it is being managed by professional managers, people who are experts, who are good in this field. It is being managed by them. When investing in bond fund, I want you to keep this in mind. One, bond fund usually include higher management fee and commission. I mean, those people, those professional manager that manage your money in investing in a variety of bond, you have to pay them money. This it is what we call management fee or commission. It depends on it. Some could be 1%, 2%, even 0.25%, it could be 0.50%. It just depends on the type of bond, the management fee. Let's go on. The income on bond fund can fluctuate. as bond fund typically invest in more than one types of bond, that it can fluctuate. Maybe now if they invest in variety of bond and the corporate bond tends to increase and tends to pay higher, but unfortunately the thing it goes bankrupt. You see that first of all it has fluctuated higher, but because of one particular bond have gone bankrupt or multiple have gone bankrupt, the price or it will have to fluctuate down, it will have to go down. So it changes, it fluctuates. I just want you to know you may be charged a redemption fee if you sell your bond shares within 60 to 90 days. That is it. You have to pay some particular fee if you decide to sell your bond shares, as in a bond that you buy, a particular bond that you bought, if you decide to sell it within 60 to 90 days, you have to pay some particular fee, because it just depends though, it depends on the type of bond. If it has not gotten to its maturity date, then you might have to pay some fee. Bond fund that are leveraged have greater risk. I just want you to know. Let us just say an example now. You invested $1,000 in a bond fund, and 60% of that your amount, which is about $600, it was used to buy a corporate bond, and the remaining 40% is being used to buy municipal treasury and junk bond. Just imagine, and that corporate bond tends to go bankrupt, it will affect your bond fund negatively. It will affect it if it has been leveraged, because it will affect 60%. 60% of your capital have gone into a bad investment, so it will affect it. If it is now being leveraged maybe times, then it's going to affect it more. I just want to, if you don't really understand, just know about leverage. Leverage is times of your investment when it is being multiplied. So bond funds that are leveraged have greater risks. We also have advantages and disadvantages of bond. Advantages is that you receive income through the interest payments. That is the interest. If you have been told that a particular interest will be given to you either monthly, weekly, so that interest could be as an income, just an income. When you hold the bond to maturity, and you will tend to get all your principal back. That is the amount you invested. Maybe you lend someone an entity or a government money, and they decide to pay you an interest monthly, maybe 5%. When it gets to the maturity date, the date you guys have agreed, if it is 30 days or 60 days, then maybe just 60 days you tend to get your principal back, the amount you invested, the amount you loan, and you have gotten also your interest back. That is exactly one of the best things. And profits, you profit if you resell the bond at a higher price. Sometimes the bond, when I said bond do fluctuate, maybe when it gets to, it has increased in value, you can decide to sell it, you will get your money back, and you also get the your profits, the increase, the difference between the selling price and the cost price, the amount you bought it, that is it. So these disadvantages of bond is that bonds pay out lower returns than stock. That's one of the disadvantages. Stock are very very volatile. They tend to pay more if you invest in stock, but they are risky. But in this bond, they are considered risk reduced. I won't say risk free. There's some certain type of risk in bond, but it is being reduced. And one of the things is that the profit, the returns you earn from it is very very low. It is not as much as stock. Company can default on your bonds. That is one of the downside. What if the companies just goes bankrupt? That is all for your money. Your money is gone. And bond yield can fall. The yield, the amount you can tend to earn from it can fall rapidly. It can go up. So that's one of the downside about bond. Tips for investing in bond: know when bond mature. That is one of the best thing. First of all, know when it's matured. when you want to invest, when a company decide to issue a bond and they say that it is for 90 days, then that 90 days is the maturity day. If they say it is for 1 year, that means a year is that a year, like 12 months is the maturity date. Know when you will get your investment back. Don't just see a bond and invest and you'll be wondering, and you'll be wondering how you're going to get your money. And if by mistake that bond maturity is about 2 years and you want to get your money within 3 months, it will be very very difficult and you might have problem because you don't know when it is going to mature. So you know when it's maturity days. Some are 60 days. So know if you want to have a quick money, your money back immediately, then go for bond that have a low, that is about 30 days, 60 days, instead of mistakenly investing in a bond that is about a year or 2 years. Also know the bond rating. You should know, do not just invest any type of bond. There are some bond that there are some company that are very very legit, they are well known, so that they have a track record of paying back. They have the track record of paying to their promise, keeping their promises. They have the track record of paying back their investor. There's some bond that will just offer an higher interest rate, and when you invest in it they can decide to fail. So just know the rating. You can check them through Vanguard. I've forgotten the name. You can just search on it and look for the rating. Investigate the bond issuer track record. That is exactly the next one. Investigate the bond issuer track record. You must know their track record. Have they been able to keep to their promises? For how long have they been issuing out bond and they be fulfilling their promises? For how much, just how known they are, for how long they've been in existence. Also read their prospectus carefully. No, read it very well, how much they will be paying you, percentage, their maturity date, and everything you need to know about this particular bond and what they intend to invest in with the money they get from investors. So read their prospectus carefully, know it very well. Also use a broker who specializes in bond. Do not just use anyhow broker. There are some well-known broker like Fidelity, like Vanguard. It depends on the broker. Use a well-known broker. Learn about any fees and commission. Before you invest in this particular bond, you must know the fees and the commission that would be incurred. So the fees, for an example, if you want to invest in bond fund, the commission management fee could be 5%, 2%, 3%. So just know the commission fee, and or just know the fees that you will pay to acquire a particular bond. What are the benefits of investing in bonds? One of the benefits of investing in bonds is safety. One advantages of buying bonds is that they are relatively safe investments. Bond values don't tend to fluctuate as much as stock price. That is one of the benefits of investing in bonds, is that it is safe. It is a bit safe. Income, the second one is income. Another benefit of bond is that they offer a predictable income stream, paying you a fixed amount of interest, twice a year. What if the bond, if they decide to pay they decide to pay you a particular amount of interest for a particular times, maybe like twice in a year, and 3 times in a year, 5 times in a year, or they decide to do it monthly, or they decide to do it weekly. It just depends. So you will know how much, if you have to be paid, you will know how much you will be getting. If you have to be paid 5% of 1,000, you will know how much you tend to be getting from the 5%. The community, when you invest in a municipal bond, you might help improve a local school system, build an hospital, or develop a public guarding. That's exactly one of the benefits, is that when you invest in a municipal bond, you tend to help your community, or you tend to help your country, because the state government tends to use that money you invest in to build school, to build hospital, to also help in building bridges. So that's one of the benefits. And another one is diversification. Perhaps the biggest benefit of investing in bonds is the diversification. Bonds brings to your portfolio. Over the long run, stocks have outperformed bonds, but have a mix of bond reduce your financial risk. That is, no, it's just diversification in a way. Maybe you invest in bond fund, it is being diversified. Some are going into corporate bond, and in a corporate bond we have like different corporates, not just one company that is investing, maybe multiple company, like Apple bond, Amazon bond, Microsoft bond. For corporate, then we have the treasury bond, different types, the municipal bond, different states. It is being diversified. Your money is being diversified. So if one should default, it will not affect all your investment. That's exactly one of the best way, or one of the benefits for investing in bond. What are the drawback of investing in bonds? One of the drawback is credit risks. And it is very, very dangerous, credit risks. Another one is liquidity risks. Another one is smaller returns compared to stock. That's exactly, it tends to earn low than stock. Bonds lock your money away for a fixed period of time. Another drawback is that it tends to lock your money for fixed period of time. It could be a yearly, maybe you invest 1,000, and they decide and the maturity date is for 1 year. It means you will not be able to withdraw that your money for almost a year. And if you want to withdraw it, it will take you time. You will also pay a fee, and you will have to go through stress. Another one is interest rate risks. What are the credit risks? Credit risk is also known as a business risk or financial risk. It is the possibility that the issuer could default on its obligation. Like I said, that I've always said before, if it is a company bond, it can default, go bankrupt and everything. This credit risks. That is one of the downside of investing in bond. Liquidity risk is the possibility that an investor might wish to sell a bond but is unable to find a buyer. That is one of the downside, is that if you decide to sell your bond before its maturity date, before you get a seller, it might be difficult. You might go through stress and every other thing. We also have the interest rate risk. When interest rate rises, bond prices fall, and the bond that you currently hold can lose value. Interest rate movements are the major cause of price volatility in bond markets. We also have the stocks tend to earn more than bond. If you look at the period since 1928 to 2010, you see that stocks average a return of 11.3%, but if you look at the bonds return, it average a return of 5.28%. That is, stock tend to pay higher than bond. You don't earn much in bonds than in stock. Where can you invest, or where can I buy bonds? You can decide to buy your bonds. You can go to the bank. They can help you out. Your bank can help you out. It depends on your bank that you are using. You can also use brokers, bond brokers, people that invest in brokers that invest. You can just go through them through online. You can it depends on your country. It depends on the country you are from. Like in the US, we have the Fidelity, we have the Vanguard. For the UK, I don't know, but you need to search. So it depends on on your broker. So this is exactly where you can invest in bond. But before you invest, I want you to know that always read the prospectus, do your research, know the background, its rating, for how long it has been in existence, its issuer, the bond issuer, know its previous payments and everything, how it has been paid, how consistent it has been, so you won't go into scam or invest into a bad, put your money in a bad investment. And so that is all for this channel. I hope you enjoyed this video. I hope you learned something about this. In this channel, once again I teach about personal finance, investments. I just wanted to subscribe on this channel, share this video, and God bless you. Comment, like this video. God bless you. Goodbye.